welcome to today's webinar on SIPP versus SAS. My name's Lisa Webster and I'm Senior Technical Consultant here at AJ Bell. So on the agenda today then, I'm going to start by having a look at the SAS Basics. So that's going to be looking at the parties involved in a SAS and what it takes to set it up, get a SAS up and running. I'm then going to have a bit of a look of a comparison on group SIPP versus SAS, because generally speaking, when we talk about SIPP versus SAS, it's normally multi-member schemes that we're looking at. So I'll look at how they work in different ways and sort of we can have a look at the pros and cons on that. I'm then going to look at why SAS and look at some of the things that you can do with a SAS which you can't do with a SIPP. And then the last section, we'll just be talking about transfers and takeovers of SAS schemes and you know what's different about those which if you're not used to dealing with SAS. You know, say there are some differences with how that works to other or certainly to SIPP pension transfers. Okay, so starting then with the basics. So a SAS stands for a small self-administered scheme. So small is the key word on that. You can have a maximum of 11 members in a SAS scheme. Now, some of you might be going, you've in your head somewhere, something going off saying about 12 members. You do sometimes see it written about there being 12 members, and that is because in legislation, the way it's worded, it actually says that it has to be fewer than 12 members. So 12 is the number that's written in legislation. However, it is fewer than, i.e. 11 is your maximum. Now, having 11 members in a SAS would be pretty unusual. It's far more common to have somewhere between 2 and 4 members of a SAS. You know, that's the sort of normal size scheme, like most of our schemes would be. But you can certainly have, you know, 5, 6, 7 members. You know, there's no issue with it, say up to the 11 members of the scheme. And it is normally going to be directors of a business or senior managers, senior employees that generally that you know control the business. That's normally who will set up a SAS and join the SAS. But it is an occupational scheme, so it does have to be a sponsoring employer. But that employer, once the scheme is set up, can actually invite anybody to join the scheme. So it doesn't have to be just senior employees, but in practice, that's usually the situation. You can also invite other people who aren't employees to join the scheme. Most commonly on that, it would be family members. So, you know, even if you had, you know, a family business, you might have somebody in the family who's not in the business, but might still want to join the pension scheme. You know, that is allowed as well. The key thing really for a SAS to be an occupational scheme is that it has to be established by the employer for the benefit of 1 or more employees. And then after that, say it can invite other people to join as well. So in terms of the sponsoring employer, most commonly it will be a trading company that will establish it for the benefit of their employees. Even with that, sometimes you have to be a little bit careful because of directors. If it's the directors who are setting it up, depending on you know how things are structured in the business and how they take their remuneration, whether they are actually employees or not. So they can be, but they're not always. As I say, you always have to have this at least 1 employee that it's set up for the benefit of. But then even if there are directors that aren't employees as such, they can then be invited to join, but you have to have that 1 employee first. Investment companies can set them up as sponsoring employers as well. Similar partnership, again, probably quite common with a partnership that the partners aren't necessarily employees, but then they might have, you know, senior managers or people in there that join the scheme, but they can set it up for them, and then the partners, the partnership as the sponsoring employer can invite partners to join. Sole trader is a bit more unusual, but technically it is still possible that a sole trader can have an employee, and in which case they could still set up a SAS if they did it for the benefit of their employee. And then again, the sole trader could then invite themselves effectively to join the scheme. But if they don't have an employee, then they couldn't do it. So yeah, the really key thing, is it's established. The actual scheme itself is established by the employer. So Quite different to a SIPP, because obviously when you join a SIPP, you are joining an established scheme. I mean, our Invest Centre SIPP has been running for years. If somebody, you put an application in for one of your clients to join our SIPP, they're joining an existing scheme that has already been established. When you have a SSAS, when you're setting up a SSAS, you are setting up a new scheme for that employer every time that you do a SSAS, whereas with a SIPP, so you're just joining a scheme that's already there. And that's already been set up, and obviously there's rules around that in terms of who can set up a SIPP. We have, it has to be an FCA authorised SIPP operator, and somebody to operate personal pensions that's able to do that. Whereas with a SSAS, it is any employer can set up a SSAS technically on this. Now, when it comes to fees and things associated with the SSAS, because it is an occupational scheme set up by the employer can pay the fees associated with the scheme. So all the administration fees, all the setup fees, anything like that, doesn't have to come out of the scheme. It can come from the employer. And as they are setting up a pension scheme for the benefit of their employees, that is a tax deductible business expense from the employer's point of view. Things like that can be quite useful if you have the members of this scheme are people that are going to be maxed out on annual allowance. Be it just the 40,000 annual allowance, people who are high earners, and you're talking about tapered annual allowance, whatever it is. So that's restricting the amount they can put in to pensions without having annual allowance charges. And obviously, if you put them into a SIPP, then their employer, even if it's funded by employer contributions, the employer can't pay the SIPP fees, and it'd be tax deductible sort of on top of the annual allowance. Whereas with a SSAS, they can pay the fees as a legitimate tax deductible expense of the business to provide the scheme for its employees, and then you can also put in the maximum employer contributions up to the annual allowance without the members getting tax charges on it as well. So that's something that's a little bit different. Now, because you are setting up a brand new scheme each time, one of the key things with SSAS, it does take a lot longer to set up than it does for a SIPP. The scheme's not already there and you're simply joining an existing scheme. You are setting up a brand new scheme. So you would have to have an establishing deed to do that. One of the advantages of that is that every deed can be slightly different if you want it to be. You can have different scheme rules, tweaked to suit the purposes. I mean, most of them, we obviously somebody sets up a SSAS with us, our Platinum SSAS, they will have, we have a standard deed, but if people want to tweak it slightly, within reason, then, there are things on that can be done, which obviously you couldn't do with a SIPP on that. Once you've got your deed and you've got your trust established, it then has to be registered with HMRC to become a registered pension scheme and be eligible for, as a tax wrapper and getting all your tax reliefs, etc. Now, this can take some time, and it seems a little bit potluck at times with the schemes. So HMRC have to do checks on all the parties involved before they will approve the scheme. And when they approve the scheme, they will give you the PSTR, the pension scheme tax reference number. And basically, you can't do anything. You can't make contributions in, transfers in, make investments, do anything with it until you've got that. And it can take a little while, but well, in recent years, certainly sort of since COVID, and and since then as well, not just during, it seems like there have been times when there's been quite a backlog of SSAS registrations with HMRC sat on their desk, but then they'll suddenly, it seems like, put a load of resource on it and then they'll clear it all. So there are times when we have seen, registrations can take several months to come back, and then other times you might get them back in a couple of weeks, because it depends on whether you're hitting the period of when they've actually got people working on it, is what it appears like. Obviously we don't know exactly what's going on behind the scenes, but yeah, it's just one to be conscious of if you are establishing a SSAS, is that it is a much longer process to register it. So if you've got transfer deadlines and things that you're wanting to putting into, if you've got property you want to purchase and you've got deadlines, you need to set it up well in advance of that. because the actual setup process, you might get lucky, it might only be a couple of weeks, it might take several months, and you know, it's really kind of is out of our control. And you know, speak to other SaaS providers as well, and it's the same situation across the board. So you know, it's not just us, it's just how things work at that end. So just one to be aware of, really. So in terms of the parties involved, so one thing I will just say, go back to the sponsoring employer, quick thing to note on that is obviously you need to have a sponsoring employer when you set up the scheme. However, it is effectively like a one-off test. You don't have to have a sponsoring employer on a continuing basis. So somewhere down the line, if you know the business owner sets up a SSAS, they have the transfer of pensions in or the contributions over the years or whatever else, you know, and then at some point in the future they sell the business, you can break the link between the sponsoring employer and the SSAS. So obviously they sell the business to new owners, it goes off, and the SSAS is separate from it, and it doesn't have to have a sponsoring employer on an ongoing basis. That is fine, you can carry on with it like that. So say it's just at the time it's established that it has to be there. You can also have more than one sponsoring employer. So if you have like a group of companies, you can link all the companies to it. If you want, one scheme would set it up initially, but then the other ones can join the sponsoring employers. Or even if you have, for example, you know, husband and wife, and they both have their own businesses, they want to pull everything together in one SSAS, they could link both their companies to it. That is possible as well. So moving on to the other parties to the scheme, obviously you've got the sponsoring employer, but who's going to establish it with a trustee? So obviously you're going to need trustees. Now, you know, since A-Day, there's no longer a requirement for professional trustees to be involved, though obviously in a lot of cases there are, and you know, there's good reasons why you would want to do that, which we can sort of come on to. But all members of the scheme will usually be trustees. Now, the reason for that is to qualify as what we call a relevant small scheme, all members must be trustees. So vast majority of SIPPs, SSASs, that will be the case, all members will be trustees. The reason you want that is that it exempts you from all kinds of rules and extra requirements revolving around it being an occupational pension scheme. So if it is not classed as a relevant small scheme, which means basically relevant small scheme has to have less than 12 members, all members have to be trustees. If you don't meet that requirement, you have lots of things to worry about, like a statement of investment principles, disclosure of charges to members, requirements for independent governance, committees, audited accounts. There's a whole long list of extra requirements, administration costs, obviously, is off the back of that, which will, you know, you will have to adhere to unless all members are trustees. So it really is important for a SSAS that you have the members as trustees. So who could be a trustee? Well, generally it's anybody who's over 18. Legally capable of holding property. They have to have mental capacity, because you can't be a trustee if you don't have mental capacity on it. There are certain disqualifications, you know, people who've convicted of fraud, bankrupts, somebody's been disqualified as a director, usual exemptions that you would expect for generally for being a trustee. Then they can't be trustees. But most adults, most over 18-year-olds would be eligible to be a member trustee. The other main role in a SSAS is the scheme administrator. So when the scheme is established, on your establishing deed, you have to appoint a scheme administrator who has a lot of responsibilities for reporting to HMRC about the scheme. So when part of the checks when it goes off to HMRC and you know, where they're going to register the pension scheme, you know, they will look and see whether they have any reason to believe that whoever's been appointed as the scheme administrator doesn't meet what they call the fit and proper test. So a reason you could fail the fit and proper test would be if they thought that the person who is the scheme administrator doesn't have sufficient working knowledge of pensions and pensions tax legislation to be fully aware and capable of assuming the significant duties and liabilities of the scheme administrator, or does not employ an advisor with this knowledge. So you can have, you know, some providers will act just as a scheme practitioner, and the scheme practitioner will act as effectively as an advisor to the scheme administrator, but it's kind of like the scheme administrator is still the one with the liability on it, not the practitioner, but at least they have got somebody there who should know what they're doing, which is probably preferable to people just doing it by themselves. You know, theoretically, yes, you know, somebody who had no knowledge could set up a SAS, but, you know, they're very likely to sort of end up in trouble, really, unless they have this knowledge of pensions and pensions tax legislation, because it is quite onerous in terms of the reporting, what they have to do. It's also very easy to make things like unauthorised payments without realising, and ending up with tax charges, etc., etc. There's also other obvious reasons why people might fail the fit and proper test. And again, you know, if somebody's been, you know, discharged back from disqualified as director, so as I was talking about with trustees, yeah, anybody's been involved in pension liberation, you know, anybody's been involved with a pension scheme that's been deregistered by HMRC, anybody's been involved in fraud, you know, things like that. There's lots of reasons why they might not miss the fit and proper test. Say on our schemes, when we do SSASs, say on Platinum, we always act as scheme administrator and trustee. But, you know, that's not the case with all providers. Some might do it slightly differently. In terms of regulation, sometimes, you know, people think that SSASs aren't regulated. That's not the case. They're not regulated in the same way that SIPPs are, and it probably is a lighter touch, I think it's fair to say. So obviously SIPPs, personal pensions, are regulated by the FCA. SSASs are regulated, but as an occupational scheme, they are regulated by the pension regulator, TPR, instead. Now, only schemes with 2 members or more have to actually be registered with TPR. So if you do have a single member scheme, which is possible, then you don't have to register it with TPR. But any of you on 2 members or more, then you do. In terms of the process, obviously, you sponsoring employer sets up the scheme with their trust deed. They send that off to HMRC, for HMRC to register the scheme to get your PSTR number, your pension scheme tax reference number. Once you've got that, then you can register the scheme with the pensions regulator. You can't do it before. So when you're looking at sort of the process of, you know, actually starting to do something with the scheme, you can, once you've got the PSTR number from HMRC, they can make contributions and you can start making investments. That's fine. When it comes to transfers, theoretically, at that point, you can make a transfer in, but some providers will not transfer to the scheme if it's 2 members or more until it's been registered with the TPR. They say it does depend who you're transferring it from. That's not a fixed rule, in the same way as having to have it have a PSTR number, but you may well find that if you're wanting to do transfers in, that providers won't do it until you've had the confirmation of the registration with TPR. So again, that's another step in the process, which means it does take longer to set up a SAS and to get everything in place before you can start, you know, doing your transfers in, you know, and using it, you know, how you intend to. But as I said, once you've got your PSTR number, you can start with contributions, at least even whilst you're waiting for the TPR registration. Now, I'll start off really by saying that most SSASs, in practice, you're probably only going to put employer contributions in, because if you've got senior employees, directors, business owners, basically, who are the members of the SAS, then it's normally more efficient to make employer contributions because of the NI savings on it, in which case the scheme itself isn't claiming tax relief. You know, you're not worrying about member contributions, it's mainly just employer contributions. However, it is of course possible still to have personal contributions into a SAS. And there's 2 ways of doing that in terms of getting tax relief. You have either net pay or relief at source. So relief at source is what personal pensions operate on. They don't have a choice because net pay is only available under occupational schemes. So, you know, your SIPP, as you'll know, is operating at relief at source. So any personal contributions come in from taxed income, you pay a net contribution net of basic rate tax, the scheme claims back the basic rate tax from HMRC, and anybody who's a higher additional rate tax relief taxpayer, sorry, has to claim that additional relief from HMRC directly, either by self-assessment or contacting them direct. It's very, very unusual for a SSAS to operate relief at source. It can be done. You can register a SSAS for relief at source. That's fine. It's perfectly possible. But obviously, there's a lot more administration in that, because it is the scheme administrator that's doing the returns and that's claiming the tax relief. You know, and it takes you these 7 to 11 weeks to get your tax, to get your basic rate tax paid back into the scheme under relief at source. Net pay is the alternative, is where the contributions are collected by the employer before income tax. You still pay NI on it in the normal way, but it's collected before income tax, and then it gets paid across gross to the pension scheme. So most SSAS would be net pay. So any payment would come in gross. The scheme itself doesn't actually have to claim any tax relief back, because it would all effectively, because the employer is taking it out of gross pay before tax on that. We do have this net pay anomaly at the moment, which means if you have any low earners, they miss out on the tax relief, because effectively if you're not paying the 20% tax to start with, you don't get it back. It's less likely to be an issue with the SSAS, just because the nature of people that are normally SSAS members, they're normally not going to be the low earners. But theoretically that's the case. A scheme can either operate net pay or relief at source. It can't pick and choose and do some for some members and some for others. So for example, if you had a scheme where you had directors or whatever in the scheme, and they're wanting net pay, but actually one of them has got their spouse in the scheme who isn't employed by the company and therefore can't do that, they want to do it relief at source, then you can't do it. Now if that spouse, that non-employee, wanted to make personal contributions to the scheme, they can still do that, and it'll go in as a personal contribution. They would have to claim, and they would still be eligible for tax relief if normal rules applied, but they would just have to claim it all back directly from HMRC in order to be able to do that. Okay, moving on then to looking at group SIPP v SSAS. So one of the most common ways where you would be looking at this comparison is in relation to property purchase. So if you've got 2 or more members coming together to purchase a commercial property in a pension scheme, that's probably the most obvious example where people will look at, do we do a group SIPP or do we do a SSAS? What is more appropriate for this? And the way they work is slightly different. So if you were to do a group SIPP, the vast majority of providers will do a group SIPP is really a group of SIPPs. So what will actually happen is that each individual will have their own SIPP, which has its own bank account in it, and they can have their own investments in there, which are completely separate. So in this example, we've got a wealth manager in one, and we've got, like our funds and share service in another one. They would have that, and then if they had their own investments, but then they wanted to buy a property jointly, what you would do is set up a joint bank account between the 2 schemes, which both of them would pay into in order to then purchase a commercial property. Now, with that, the property would be held jointly between the 2 pension schemes, or it could be 3 or 4, it could be more, on a tenants in common basis. And so there would be a percentage split based on what they paid in as to which, how much of that property each individual SIPP owned. If you're borrowing to fund the property purchase, effectively each SIPP would have to take out an individual loan, because there is no kind of joint entity, if you like. It is, a SIPP would have to take out a loan, B may or may not need a loan, or then there might be a C that did need a loan, whichever. So there would be separate loans which would all be secured on the same property. So obviously you'd have to use the same lender for them all, and you'd have to structure it properly, which there are certain lenders that are used to doing it and understand how that works. May not be just your local bank manager, whatever, depends on what experience they have of dealing with it, because it's not more straightforward. But the point is, it's separate loans all secured on the same property. So really, when you look at it, they are still separate SIPPs. They just, one of them might own a bit of, A might own 40% of the property, and B might own 60% of the property. Now, when the rent's coming in on that property, it'll go into that joint bank account, and then it'll get distributed in the proportion of the ownership between those two SIPPs for them to invest and do whatever else. When it comes to, you know, move on a few years after they've bought this property, and maybe, you know, one of them wants to retire, wants to start taking some income out of their pension, the other one might be a bit younger or whatever and still making contributions, it's not as straightforward if you've got liquidity building up in one SIPP but not in the other, because effectively you would have to, you know, to shift it between the two, you'd have to buy, one would have to buy a bit more of the share of the property from the other. So for example, you know, if A is now, you know, wanting to take income, if they don't have enough liquidity within their own SIPP, but B's got more liquidity, you know, they're putting contributions in still, they've got a bigger share of the rent coming in. If you wanted effectively over time to buy them out of the property, you would have to do a series of transactions to do that, because, you know, effectively once you've purchased the property, that split is fixed. So unless you have other transactions to like buy a share from one SIPP to the other to move it across. Generally there's more transactions involved in this, to say, because you have rental payments going to the joint account, the payments going out into the individual accounts for them. If there's loan repayments, they have to be paid out from those individual accounts that have taken out the loan as well. So, you know, it can work, but it can be, you know, a little bit more complicated if there are differences in you know, when you're thinking about exit strategy, if there's different ages and, you know, different needs in there. It's just things to think about on it. When you look at SSAS, it's different. SSAS is basically one big pot and everything is pooled in it. So you have your 2 members, 3, 4, 5, however many members you are, you have your one scheme, which is normally named after the company, ABC Limited SSAS. You can call it whatever you like. There's no really strict rules on this. You can have family pension trusts as well. Call it what you like on it, really. Now, within that SSAS, you will always have a bank account. You can normally choose who that is, or choose if you want a second account after you provide as main one. You could then have your various investments within it. But because this is its own individual trust, it is its own legal entity, it is the SSAS itself as that legal entity that purchases the property, with the, obviously with the trustees' names on it. And you can change trustees if necessary, if people left the scheme or new members joined, but it's still the SSAS that is the legal owner of that property. And because everybody in the scheme owns a bit of everything, it's much more fluid. So there will be a percentage split of ownership of the SSAS depending on what everybody's put in terms of their transfers in and their contributions. So if somebody starts taking benefits, then their percentage share of the ownership of the whole lot is going to go down. People are making more contributions, and that's going to go up. What this means is, if you've got, same scenario, if you've got a couple of members who are maybe different ages, one wants to take benefits, the other one is still making contributions, effectively, you know, and you've got rent coming in as well, you know, you'll have some liquidity from that. Essentially, you could use that rent, you can use those contributions to fund the person who's taking the income, to fund their income payments. And what will happen is, over time, is the percentage split of ownership of the whole SSAS will go, you know, it will move in favour of that person who's still making the contributions. So for sort of succession planning, exit planning, things like that, it can be quite useful, because it's you know, it's just a split that the scheme administrator you know, would monitor, you know, the trustees approve it, sign it off, that they would have, so that changes over time. So it's much more straightforward. When you're wanting to take, you know, if you want to take a loan as well to purchase property, it's one loan, you know, for the trust that the SSAS takes out. So it can be more straightforward in that sense. There are sort of pros and cons with it. So with a SSAS, all member trustees have to agree to all decisions. So it has to be unanimous decisions in terms of what's going on with the investments in there. Now, so that which isn't the case obviously with group SIPP, because people can hold their own investments separately. So people have really different, maybe they want to come together and buy the commercial property, but when they've got other money in there as well, they have different attitudes to risk in terms of what they want to do with it, what they want to invest in. Obviously it's really simple to do that with the group SIPP. It's not as straightforward with the SSAS. Now, what you may be able to do with the SSAS is what's called notional earmarking, where you can actually say, well, this portfolio over here, this relates to member A, and this portfolio over here relates to member B. Now, whether you can do notional earmarking or not will depend on the scheme rules. Not all SSASs will allow it. Some of it will just be everything's pulled. Some will allow notional earmarking. But as I said at the beginning, when you're setting up your SSAS and you're writing your establishing deed and you have your scheme rules, you can write that into the scheme rules or not as you wish. So, you have that control, which obviously you don't have, under a SIPP, to be able to tweak things. So that's one thing that you might want to think about, whether you want to have that power or not, depending on the members. Obviously, because everybody has to agree to everything in a SSAS, it can cause issues. There's no denying the fact that there can be some nightmare scenarios with SSASs where members have fallen out and they don't agree to things, and it can cause all kinds of problems. We've seen cases end up in court because of disputes going on between the members. When it comes to buying a property and things like that, you should always, at the point that you do it, have an exit strategy in place. What happens if somebody wants out? What happens if somebody dies and their widow doesn't want, or their beneficiaries, whoever it is, don't want to take it over? When people take benefits, what's going to happen? You need to think about these things before you actually make the purchase. Looking at things like that. In terms of fees, in terms of group SIPP versus SSAS, obviously it will depend on the provider. Everybody's fees are different. Generally speaking, if you have 2 members, a group SIPP might be slightly cheaper. Once you get to 3 or more, then it tends to swing the other way, and a SSAS is likely to be the more cost-effective option, if that's a factor. Obviously, I should point out now, as I'm sure some of you watching this will be aware, that we no longer do properties on group SIPPs, on SIPPs anymore. That's just a business decision that has been taken. But we do still, you can still purchase property via a SSAS with us, but obviously lots of other providers do property via a SIPP. If you've got property in a SIPP with us, it's fine. We are continuing to look after, and we'll continue to look after the ones we've already got. We're just not putting new ones in on the SIPP side of things, but we are on the SSAS. So yeah, just one to be aware of on that mention. One more thing on the SSAS before I move on, and this kind of structure of it all being one big pot. I've sort of touched on death benefits, and I say it can be better, sort of more for sort of fluidity and things. Now, quite often with SSAS, because you do get a lot of family SSASs as well, because you can invite other family members to join the scheme, or you might be family businesses. Quite often you might have a beneficiary who's actually already a member of the SSAS, and obviously that makes death benefits really easy. They just makes they'll have another share. They'll still have their members pot and they'll have a beneficiaries pot, but it's all within the scheme anyway. That makes things really straightforward. You can actually have beneficiaries that are under 18s, which we sometimes get asked about. Now, said all members have to be trustees of the SSAS to be qualified as a relevant small scheme, and obviously you have to be 18 to be a member, but you can be a beneficiary of a SSAS without being a full member. So it's like a different class, if you like, and you don't have to be a trustee in that case. So you could have somebody who was under 18 who was a beneficiary, owning, having the right to a share of the SSAS. Normally you would only really want to do that if it was a family scheme and there were other family members who were the trustees making the decisions, because obviously they should then take into account what's in the best interest of that beneficiary when they're making those decisions as member trustees. So it's kind of, but with the family pension trust thing, that can work, and it saves having to, particularly if you've got liquid investments, this issue of having to sell it, well, actually, if they could keep this property in there, they don't need the whole lot at once. They can take a bit of income if they need to, out of the rent and that's coming in without having to sell the whole thing to do a transfer out. That can have some advantages with the SSAS, which obviously isn't an option with a SIPP. You'd have to do a transfer on that. Okay. Moving on to why else a SSAS? What can you do with a SSAS that you can't do with SIPP? Now, the obvious one is the loan back. So a SSAS can make a loan to the sponsoring employer. Obviously, you can't do it with a SIPP because there isn't a sponsoring employer involved, and you can't make connected party loans that are unauthorised payments. So SSAS is a really big, loan back is a really big draw point for SSAS. So to make a loan to the sponsoring employer, there's 5 key conditions that have to be met in order for this to be an authorised payment. And these relate to the security, interest rates, term of the loan, maximum amount of the loan, and those repayment terms. So we'll look at those each in turn. Security, first of all. It has to be the full amount of the loan plus interest has to be secured with a first charge. So in an ideal world, then a SSAS making a loan to the sponsoring employer would have security of a commercial property. That would be the perfect scenario. Perfect scenario when it doesn't have a mortgage on it, because it has to be the first charge. So if there's a mortgage on it, no lender is going to let you take priority over the mortgage. So it's not going to be practical. So it'd have to be an unencumbered commercial property. That would be fantastic. Now, in the real world, that does happen sometimes, but not that often. And if we look at alternative security, then you can use other assets, be that anything that's owned by the business, whether it's got big bits of machinery sometimes, depending on the nature of the business. It can be taxable property. So taxable property will be anything tangible, movable property, which a lot of big machinery will be, even if it takes a crane to lift it or something, if it's movable, or residential property. Now, there's a couple of things to sort of be careful with this. So if you use taxable property, if a SSAS, if the pension scheme takes an interest in taxable property, tangible movable property or residential property, then there will be an additional tax charge related to the value of that interest, if you like. It's the consideration given for the interest. So normally, at the point you put a charge in place, there isn't actually consideration. You don't pay anything for that, but there will be some legal fees to put that charge in place. Now, if those fees came out of the scheme, they would be an unauthorised payment. However, because it's an occupational scheme, the employer can pay the fees, the legal fees. That's fine. In which case, then if the employer pays the fees for putting the legal charge in place over the taxable property, then at that point in time, there is no unauthorised payments. So it can be done. However, you need to be really, really confident that you are not going to have to call in this security, because at the point in time that you call in the security on that loan, then the scheme will get an interest in the taxable property, and it will be the full value of the taxable property on it that will have the interest that. So that's going to be a significant, particularly if you've got a residential property, that's going to be a significant unauthorised payment charge. So, and when you're using taxable property as security for your loan back, you will need the asset, the property, whatever it is, to cover the amount of the loan, including interest and any potential unauthorised payments. So you need a much higher value of that asset as security than you would do if it was a commercial property. So it's not impossible, but I would say proceed with caution, because I say if it gets called in, then you're going to end up paying a lot more charges on it. The other thing to say about that is if you are going to use residential property, I really, really, really wouldn't advise using the member's own personal property. The problem with that is, of course, is if the loan defaults it's because the business is struggling. So if the business is going under, in which case, you know, they can't repay the loan, and it's the business owner's, you know, it's the business owner's personal property, his business has gone under, do you really want them to lose their property, lose their house as well, lose their home as well as losing their business? I don't think I'll be sleeping comfortably at night on that one. So, you know, using their home, their house, yeah, I definitely would proceed with caution on that one. It may be if they have a buy-to-let property, or if they have a holiday home, second house, whatever, which doesn't have a mortgage on it. Again, it still has to not have a mortgage on it, because it still needs to be the first charge. Then that might be more palatable, because, you know, worst case scenario, if the business couldn't pay back the loan, the business went under, you lose your second property, you've still got somewhere to live. That might be more a risk that people are willing to take than, you know, risk losing their house as well on that. So I say, ideal world, yes, you have a commercial property which has no mortgage on it, but otherwise you can consider using taxable property, but you just need to be a bit aware, you know, obviously it is higher risk to do that. Next up is interest rates. So there's a minimum interest rate that you have to charge on SSAS Loanbacks, 1% above the average of base lending rates of the 6 leading banks, calculated up to the nearest 0.25%. So looking at the figures on this is actually the same as the underpaid corporation tax self-assessment published on HMRC website, which when I looked at that a few days ago, so middle of August, it was 2.75%, I think was the minimum on that. At the moment, obviously things are changing swiftly, and if you're watching this back on the website a few months later, it could be anything, who knows. But there's no maximum interest rate stipulated by HMRC. And obviously, sorry, I should just say, obviously that's the interest rate that's put on at the start for the period on it. There's no maximum, say, stipulated by HMRC, but we would want to know that it was on commercial terms and on an arm's length basis. We have to be careful that, you know, you don't overpay a massive amount of interest as a way of getting money from the business into the pension scheme. Sometimes it might be tempting, particularly if you have, I say, you know, people that maybe are affected by the tapered annual allowance, or people who've used up all their annual allowance. You think, well, actually, the business can pay interest. It's tax deductible business expense. It gets money into the pension scheme. So you can see there's a reason why people might want to overpay, but obviously it has to be an arm's length commercial basis. So there is a limit to how much you can overpay. You know, if it's more than, you know, about 3% above the published rate, then we might look at that and want, not saying you couldn't do it, but we want evidence that that is a commercial rate before it was agreed on that. Terms for loanbacks is a maximum of 5 years. You can have a rollover once if and only if the firm the employer is in genuine difficulties making repayments. So you'd need evidence that the employer is struggling. So you need to see accounts basically on that. And if that was the case, then you could grant a rollover for a maximum of a further 5 years on that. Your existing security can carry on. You don't have to reassess security at that point in time. With COVID, we did have a temporary relaxation on this. So we didn't have to get the evidence of employers struggling during COVID if we had people who couldn't repay it at that point in time. Obviously, a lot of businesses were closed, including accountants, to provide accounts to show us that the businesses were struggling. Yeah, the HMRC did have a relaxation in place, which we didn't need evidence. We could just roll over SSAS Loanbacks. That's all gone out the window now. That's all stopped. You know, we're back to the old rules. So if anybody couldn't make the repayments, we'd need evidence of your genuine difficulties in order in order to be able to do a rollover on that. The amount of loan that a SSAS can make is 50% of the net assets of the pension scheme. So if you've got a £500,000 pension scheme, you can lend £250,000 to the sponsoring employer. It's a one-off test. It's the date of the loan. So, you know, if you have £500,000 and you make a loan of £250,000 to the sponsoring employer, and then the markets crash and your other investments in the scheme go down, it doesn't matter in the sense of the loan back, it might matter in other ways, but yeah, it's a one-off test at the date of the loan on that. The repayment terms then, you have to repay equal instalments of capital and interest for each year of the loan. The way that's calculated, put figures on it, I find it makes it easier to understand. If you have the loan plus your total interest over the period of the loan, divided by the total number of the loan years, times the number of loan years in the period, that's how much you have to pay. So I say I'll put numbers on to explain that. If you have a £100,000 loan for 5 years and your total interest was £15,000, then in year 1 you've got your loan plus interest, so 100,000 plus 15,000 divided by 5, which is the total number of loan years, times 1 because we are in the first loan years in the period. Then you have to repay a minimum of £23,000. Second year, the total repayment has to be 46,000. So you could overpay in year 1, pay a bit less in year 2, as long as the total at the end of the 2 years was the 46,000, and so on that one. Right, so that's your requirements for loanbacks. The other investment that you may have heard about or is talked about sometimes is that SAS can do that a SIPP can't, is revolving around company shares. So the rules state that a SAS can invest in shares of a sponsoring employer. It's allowed to use a maximum of 5% of its scheme assets to be invested in each sponsoring employer. So as I mentioned at the start, you can have more than one sponsoring employer associated with the scheme. So a maximum of 20% of scheme assets invested in all sponsoring employers. There's no limit on the amount or the percentage of company shares that are held. So in theory, if you had a really big pension scheme and a really small company, you could use 5% of the scheme assets of the SAS value to buy an entire company, theoretically. So it's the limit is the scheme assets, the 5% of the scheme assets. However, I'm going to put a big warning sign on this. So this is the scheme rules. This is what it looks like you can do. However, big caution. We still have taxable property rules, which some of you may be familiar with. So we talked about residential property for security, but if a pension scheme directly invests in a residential property or tangible movable property, anything you can pick up and touch and move, apart from investment grade gold bullion, then it's an unauthorized payment, and there's horrible tax charges associated with it if you buy them directly. So we all know that you can't put residential property in a pension scheme. However, this also implies to an indirect investment if you have control of it. So if you are investing in the sponsoring employer and that sponsoring employer owns taxable property, it may be the case that you have an indirect investment in taxable property. So taxable property for these purposes is anything more than worth £6,000. If you have an indirect investment in a company and that has more than £6,000 of taxable property, then you potentially got an issue. Now, most employers are going to have taxable property or something, be it a mobile phone, laptops, even if obviously the companies will have a lot more than that, but even the most basic business is likely to have some taxable property owned by the business. Also, the £6,000 limit, which you can ignore, is only if it is purely used for the business. So actually, if you even have a small business and they've got, like I say, a mobile phone and a laptop that they use, if they have any personal use for it, it doesn't meet the exemption, even if it is worth less than £6,000. So you have to be really, really careful with this. In terms of, it's only if you have control of the business that this is an issue, that you're classed as having an indirect holding of the taxable property. But the very nature of SSASs is normally the business owners, so they normally will have control of it. Technically, they are defined as having control of the business if you are a director of the business and you own or control more than 20% of the shares of the business. So that would be the shares that the member owned personally, the shares that are owned by the pension scheme, if you're talking about the SSAS buying it, the shares that any spouse or family members have as well. So for most directors, that's likely to be the case, and so therefore they would have it would be an indirect holding of taxable property of the purchase shares, or it could be if they're not a director, but if they own more than 50% of the shares, or again together with connected parties, so with their own pension scheme or with other family members. So in practice, it's very unlikely that you're actually going to be able to use a SSAS to buy company shares because of the taxable property rules. Now, this is another example. At the start, I was talking about fit and proper people to be scheme administrator, and somebody with which one of the criteria on it, TPR's point of view, is about somebody who has sufficient knowledge of pensions and things. That it's really easy for people who don't use professionals to fall foul of rules like this, because you can look at the rules and you can look it up and you can look in pensions tax manual and it'll tell you these company shares rules that I've got on the slide. It won't warn you about taxable property because the taxable property stuff is on a different page somewhere else. And if you're just looking at one bit of it and you don't know to look at the other bit, you don't know the whole picture, it's really easy for people to get things wrong inadvertently, not because deliberately, doing something wrong, but easy to make mistakes, and then they can end up with unauthorized payment charges, and they can be pretty hefty on that as well. So it's just one to be careful of, making sure things are done right with it. Last little bit I'm going to talk about is transfers and takeovers. So you can transfer other pensions to a SSAS in the usual way. So if people have got personal pensions elsewhere, occupational pensions elsewhere, then in terms of a transfer, it's a straightforward transfer. There are, you may well find, again, sometimes to start setting up SSASs can take longer. Transferring to a SSAS can also take longer. I'm sure a lot of you will be aware we had changes to the statutory right of transfer that came in November 21. And there are new rules now, which is all to do with preventing scams. SSASs in the past have had a lot of bad press regarding scams because they are a vehicle that scammers have liked to use. It doesn't mean that there aren't very legitimate reasons for doing SSAS, but it does mean that some providers, trustees, are more wary of transferring to SSASs. It's also because every SSAS is set up individually. Even if providers have like a whitelist, if you like, of schemes they're happy to transfer to, your SSAS is never going to be on that whitelist because it's individual. It's a separate scheme. They've never seen it before. So it's always going to be looked at on an individual basis when they are assessing about doing the transfer. Under the statutory right to transfer, a statutory right to transfer exists to an occupational scheme if you can demonstrate the employment link. So pretty much every SSAS, when you're going to transfer your client from their existing pension scheme to a SSAS, you can expect they will ask you to demonstrate the employment link to the sponsoring employer. What they are likely to ask for on that is a letter from the sponsoring employer to tell them that your client is an employee of theirs. They are likely to ask for evidence of 3 months pay slips to show that they are being paid by that employer, and also likely to ask you for evidence that that employer is making contributions to the scheme for your client now, and has done so in the last 3 months prior to the transfer request. Now, sometimes that can be straightforward, but it's not always going to be straightforward. As I touched on before, directors might not always be employees. Directors might not always be taking a salary from it, so might be being paid by the employer, just depending on when, if your employer makes a one-off employer contribution, depending on your timing, it might not have been within the last 3 months. If you've set up a new scheme, they might not yet have done that. They might be waiting for company year end to do it. So that's quite common. And if you're not setting it up round company year end, then you might not have made it in that 3-month window. So there are cases where you're not going to be able to demonstrate that. The other one would be, say once the sponsoring employer has set up your scheme, you then have you can invite other people to join, like family members, for example. So you might have people that aren't employees that are wanting to join the SSAS as well. So basically, if you can't demonstrate that evidence, then there isn't that statutory right to transfer in the same way. However, it doesn't mean that they can't transfer. What it means is they will normally send your client off to Money Helper to go and get pension scams guidance, and they will have to get that pension scams guidance and go back with a reference to the scheme administrator trustee of the seeding scheme to show that they've had that scams guidance before they will allow the transfer on it. So it's not that it can't be done, it is another step in the process though, that it means it is likely to take longer. So it's just another thing to be aware of really on that. Next one with transfers is you may have clients that still have EPPs, executive pension plans, which you do not want to transfer as such because they have guaranteed annuity rates in them or protected PCLS and things like that you don't want to lose. But what you can do with an EPP is you can actually assign it to the SSAS, so the policy stays intact within a SSAS, effectively like you wrap the SSAS rules around the EPP, which might be useful if you are using your SSAS to do a loan back, because it will count as an asset of the SSAS, so you can include the value of it when you're working out the 50% maximum for the loan back, but you're not actually like cashing it in, or losing any of those guarantees that you've got associated with it. So that can be quite useful if you have people in that scenario. When it comes to the SSAS itself, you can't transfer a SSAS itself because SSAS is an individual scheme set up by the occupational, by the employer as an occupational scheme. The whole SSAS can't be transferred because it is its own entity as such. Individual members of the SSAS, they want to leave, they can still transfer out the normal way, to a personal pension or wherever. That's fine, they can do that. But if you decide for whatever reason you're not happy with the provider that you're with and you have a SSAS scheme, or maybe there isn't a provider, maybe somebody's done it themselves and actually they're realizing this might not be a good idea, they might want some help with it, then you can appoint and remove trustees, additional professional trustees. Obviously members still have to be trustees, talked about, but you can change the professional trustee with a deed of removal, deed of appointment for a new trustee, to put a new professional trustee in place. And with scheme administrators, you can change the scheme administrator. So that effectively is a takeover of the existing scheme. So the scheme is no transfer involved, the scheme remains intact, same PSTR number, etc., etc. You're just changing a professional trustee and on the scheme administrator. So that can happen as well. Right, my last slide is just, or nearly last slide, I should say, just a bit of a summary then, looking at the difference of SIPP v SSAS. So basics then, SIPP is a personal pension, whereas the SSAS is an occupational scheme, so you always need that sponsoring employer to set it up. SIPP is normally a master trust, can occasionally get contract ones, but they're normally one big master trust and you just join that trust when you sign up for it. Whereas the SSAS is an individual trust, it's a separate scheme every single time. If you're in a SIPP, then the assets are held in an individual SIPP arrangement. For each member, things will be held separately. You may have a joint bank account or groups formed, usually for property purchase on a tenants in common basis. SSAS is different because all the assets are pooled. So all the members have to agree to it. Everything is one big pot and there's a percentage split between the members. The SSAS itself, the legal entity that is the trust, holds a property if you're doing a property purchase. So SSAS can do loans to a sponsoring employer. SIPP can't do that, doesn't have a sponsoring employer, can't make loans to connected parties. Tax relief contribution, SIPP is relief at source. SSAS, it's usually a net pay, can be relief at source in theory, quite unusual for that to be the case. It's normally a net pay, but in practice, it's normally just employer contributions. They are both regulated, FCA for the SIPP and TPR for SSAS. So slightly different approaches on it, on that. So that was going to be my last slide, but nearly. Just going to put up our platinum consultants. So obviously another side of the business from Invest Centre, we do have AJ Bell Platinum, which offers SSAS. If you want to know more about SSAS, if you are interested in, if you've got a case, a client you think it might be suitable for, this is our team of SSAS consultants. These are our SSAS, our platinum consultants, I should say, our SSAS experts. They will be able to help you with any queries that you have, help, with, seeing if things are viable, talking through the options in respect of SSAS. So if you do want to know more about SSAS, then contact Anne, Charlene or Mike, or you can just call the general office number and ask to get put through to either of them as well, or have a look at our Platinum website, ajbellplatinum.co.uk. It's got all their details on there as well. Right, that is all for today. So thank you very much for listening. I hope that has been of interest to you, and I'll see you next time.